Prominent Tesla short seller Jim Chanos is at it again, commenting on Elon Musk and Tesla after a long hiatus. Now that Tesla stock is down over 50% on the year, it's time for short sellers to come out of the woodwork and give their valuable opinions on how to actually run Tesla, why Elon Musk doesn't know what he's doing, and the many reasons why Tesla is headed lower. So we're going to look at the past track record for Jim Chanos, not just related to the stock price, but the comments that he's made about Tesla a few years ago and how they hold up today, as well as Jim Chanos' thoughts about Tesla in his most recent interview from just days ago. And before I continue, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and financial data going back 10 years, and it's all freely available. Jim Chanos is a short-selling giant, having spotted and shorted multiple fraudulent companies throughout his career and firms that overstate their financials. He founded Kynikos, which is his firm specializing in short selling, where he took a position against Enron, a huge victory for Chanos as Enron underwent a fraudulent accounting scandal and went bankrupt in 2001. Since then, he's also had a number of more recent wins, including Luckin Coffee, Hertz, and Beyond Meat, the latter of which is down 95% from its highs. Chanos is certainly worth paying attention to and can easily scare investors by disclosing a short position in a new stock. He isn't afraid to keep his position for multiple years, and he teaches his methods in a class at Yale centered around the history of financial fraud. However, one of Chanos' biggest mistakes has been betting against Elon Musk and Tesla, and he hasn't given up yet. Back in 2017, Jim Chanos said that Tesla was headed for a brick wall and compared the company to Enron before its collapse. At the time, Tesla was certainly on the verge of bankruptcy, as Elon Musk later admitted that the Model 3 ramp-up from 2017 to 2019 indeed almost put the company out of business. However, Tesla pulled through despite the barrage of negative headlines. That said, even in 2020, Jim Chanos had dug in his heels and announced that he was maximum short Tesla, and it was one of his favorite positions. But Tesla ran up immensely in 2020. At the end of the year, Chanos said that if he spoke to Elon Musk, he would tell him, "Job well done," as Elon had basically avoided the destruction of his company, something that short sellers were heavily pushing for. Chanos had reportedly reduced his Tesla position, but even in 2021, Tesla continued to run higher. The stock has gained at least 10 to 20 times its value since Chanos first started shorting the company, even after this year's market sell-off in 2022. Now that said, it appears that Jim Chanos uses put options to short many of his companies, which greatly reduces his risk. With a regular short, if the underlying stock doubles, the short position becomes worthless. In Tesla's case, a 20 times gain means that the short seller would need to pay an additional 19 times their original investment back to the bank. So this could really wipe out short sellers. However, with put options, they stop at zero. But if Chanos has been holding put options for many years, he may need to continuously roll over the options since they eventually expire, and so there's a continued cost of renewing the options. According to his 13F filing in 2020, his Tesla put options were set to make up about 5% of his Kynikos fund. Now looking back at one of his 2020 interviews, Chanos mentions 6 bear case Tesla arguments. Let's see how they held out. The first relates to this argument that Tesla was a car company and not a tech company, and we'll go over this more soon when we look at the recent comments that Chanos just made. As for revenue, he argued that Tesla was trading at 4 times revenue, which would be high for a car company and normal for a tech company. But actually today, Tesla trades at 8 times trailing 12-month revenue. In reality, the revenue multiple is fairly irrelevant because it doesn't take into consideration margins or how much of that revenue gets converted into profit, which is really what matters for valuations. And it turns out that Tesla's margins are some of the highest in the auto industry, and a big chunk of their revenue comes from high-margin software that auto analysts had failed to understand. Chanos also criticized Tesla's construction of new gigafactories, including Giga Shanghai and Giga Berlin, saying Tesla was building these at exactly the wrong time. Now, this was incorrect back then, but looking back, it was obviously a genius idea to begin working on the new gigafactories when they did, as they're gigantic today, benefiting the company immensely. And Giga Berlin and now Texas are well on their way to ramping up extremely fast, securing Tesla's production for years to come. Not to mention that Tesla is still looking for more gigafactory locations. Listening to Chanos would have led to failure, which is exactly what he wanted. Chanos argued that the factories weren't at 90% or more capacity, which in the auto industry means big losses, which would also be true for Tesla. Normally, Chanos would be right, which is a bad sign for traditional automakers going forward. But interestingly, the gigafactories are surprisingly efficient. Even Tesla's first major factory located in Fremont is the most productive factory in North America, and Elon Musk even has plans to further increase production by 50%. So clearly the dynamics of Tesla's overhead is very different than other companies since Chanos' prediction has been completely backwards. Next, Tesla hasn't made any money. This was true at the time, but the value of a company is based on its future cash flows, not the past. And as it turns out, Tesla today, just 2 years later, is extremely profitable, and they only produce a bit over 1 million cars per year. So this is still the early innings, especially if Elon Musk is targeting 20 million cars per year. The Tesla makes no money argument is long gone. And finally, Tesla won't have 1 million robotaxis. Well, we know for a fact that Tesla has over 100,000 people in the full self-driving beta program, which just started to go to wide release a few days ago. Elon Musk has said in the past that it could go to 1 million people by the end of the year 2022, since anyone who has paid for full self-driving will be able to access the latest software. These customers have paid thousands of dollars for FSD, which is high-margin software revenue for Tesla. Now, technically, they're not yet official self-driving robotaxis, although the software is advancing at a breakneck pace, making Tesla frighteningly close. From Chanos' angle, this isn't a very good argument, since Tesla wins in multiple ways here with a massive upfront payment for the software, followed by recurring robotaxi revenue when FSD is good enough to drive without a human monitoring it. So it was easy to say Tesla won't achieve 1 million robotaxis, but financially, Tesla is already winning, and they have significantly more upside potential. There are also now 3 million Teslas on the road, each capable of becoming robotaxis by flipping a software switch. And for more detail on what Chanos had to say, you can find my video from 2020 on the channel by searching for Chanos. Now today, Jim Chanos is back with more predictions for Tesla's future, and he's still short the company. It's interesting that by now shortsellers giving advice to Elon Musk or making predictions about Tesla stock must mean that they're up to something. To come out after Tesla stock has already dropped 55% this year, and to try and control the narrative, saying that the cause of the decline is related to something Tesla or Elon Musk has done, is of course certain to age well over the next few years. Jim Chanos is now predicting that Tesla's growth is going to slow as rivals catch up and it runs short of customers. We've been hearing Chanos say this for at least 5 years now, but Tesla's rivals appear to actually have big problems. They lack the ability to scale electric vehicles, and there are going to be many roadblocks that slow these rivals who haven't invested properly in EV infrastructure, charging, and the batteries to actually build their vehicles. Look at Toyota, for instance, which makes virtually 0 electric cars, and they had to recall all of the ones that they did have. That's a 10 million vehicle market that's up for grabs for electric vehicle companies if Toyota doesn't get their act together. Although there are multiple competitor EVs on the road, many buyers aren't touching them with a 420-foot pole, as everything from the Ford Mach-E, the Chevy Bolt, the Toyota BZ4X, and others have all had some major issue or another. With regards to Tesla's declining growth, Chanos uses a weird calculation to try and distort what the company has said. Jim Chanos says investors are still looking for 40% to 50% growth for the next decade, which pretty much means Tesla is going to be the entire car industry by the early 2030s. We just don't think that's going to happen. Now, to be fair, Tesla is already larger than almost all the other car companies combined, but that's besides the point. Elon Musk is aiming for 20 million cars produced annually in 2030. That's Tesla's aspirational goal. In order to get there, Tesla does need roughly 40 to 50% vehicle growth, which they're shooting for, and this year it will likely be closer to 40%. But the company's growth rate is actually measured through earnings, not through vehicles delivered, and earnings should actually grow much faster than this rate due to the leverage Tesla has. That last vehicle Tesla sells in the quarter or the year is all margin for Tesla, and basically the gross profit goes straight to the bottom line. So Chanos is saying that 50% growth for infinite years is impossible, but Tesla is just aiming for 20 million vehicles per year, and to get there, they'll have to have that kind of growth rate over the next couple of years, and yes, eventually the growth in vehicles will slow. Unfortunately, Jim Chanos left out the robotaxis, energy, insurance, robots, etc. that can further boost growth and margins long after vehicles slow down. Furthermore, Chanos generously says that the luxury car market is small, trying to show that Tesla will run out of people to sell to. Again, this isn't 2017, where the bulk of Tesla's vehicle sales come from the Model S or Model X luxury cars. Chanos is looking with a fine-tooth comb for small discrepancies, but Elon Musk is envisioning massive scale. If Chanos looks too closely, he might miss the big picture, which is that if Tesla's next vehicle is half the cost of the Model 3 or Model Y, as the company intends, that opens up a massive untapped market for the company that has nothing to do with the ultra high-end luxury auto market that Chanos is thinking is trapped in. Another point that Jim Chanos brings to the forefront is that Tesla's margins are around 30%, and the auto industry is lucky to get 15% or 20% margins, so this must be unsustainable. And this goes back to Chanos viewing Tesla as another car company. Again, it's hard for him to break out of this mentality. Tesla's 30% auto margins are currently based mainly off of vehicle hardware with a small amount of software. Unless you're Apple or Tesla, hardware indeed has low margins, yet Tesla is able to get up to an insane 30%. Counterintuitively, going forward, it might actually get even better for a number of reasons. One is that part of those high margins already come from FSD software. Tesla so far has not been able to recognize the full amount that people pay for FSD since the software hasn't been fully delivered or completed yet. However, with the new wide release of FSD beta, software margins could increase significantly just from recognizing a higher percentage of FSD. I won't mention the related robotaxi network that could propel margins even higher with pure services/software revenue. Actually, Chanos even criticizes ride-hailing companies of today not being able to make a profit or scale. But that's exactly where Tesla comes in, since they have all the pieces to scale at ridiculously low cost relative to today's ride-hailing players. There's also the interesting fact that Giga Berlin and Texas are both ramping up, which means they're currently putting pressure on margins since their volumes are still low compared to the cost of running these massive factories. But at a certain point, as volumes increase, they will start to contribute meaningfully to higher margins, especially if these factories are the state-of-the-art alien dreadnoughts that will happily put the Fremont factory, the most productive factory in North America, to shame. And lastly, Jim Chanos is jumping on the Twitter complaint bandwagon, saying that it's probably going to take a disproportionate amount of Elon Musk's attention over the near term. Okay, well exactly, it's only a near-term thing. But also Elon Musk can multitask, as he's been doing with his 3 other companies for years, and there's also 120,000 employees focused on Tesla's mission. Consider also, how come no one is worried about Twitter being a distraction from SpaceX? It's not a public company, but will SpaceX's missions still get completed? Elon Musk has basically increased his workload from 80 to 120 hours per week, so clearly he's been able to focus on his multiple companies just as he always has. So do you find it interesting that Jim Chanos comes out to talk about Tesla at its multi-year low? The last time he spoke about Tesla, it didn't work out too well. But do you agree with any of his current points, or will history once again not be so favorable to the short seller trying to take Tesla down? Please hit the like button and subscribe, we would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.